Welcome to Partnership Tax Fundamentals. My name is Cass Brewer. I'm an assistant professor here at Georgia State University College of Law, and I'm joined here today by my colleague, Judge Charles R. Boudreau, who is Chief Judge of the Georgia Tax Tribunal and also an adjunct professor at Emory School of Law. Our goal today is to introduce you to some basic accounting concepts that we hope will ease your transition into partnership tax this upcoming semester. First, let's talk about partnership taxation in general. It's hard. It's a challenging course. But part of the reason why, in my experience, and I think in Judge Boudreau's experience, we found that students are challenged by partnership taxation, is the notion that it's this odd blend of both legal, tax, and accounting concepts. So again, that's the purpose of today's presentation, is to actually give you a leg up on the accounting concept so that when you begin the course in earnest this semester, you will actually focus on the legal and tax aspects and how they relate to these fundamental accounting concepts. So now you might be asking yourself, when we've said, well, it's hard and it's a difficult course, why? Why would you want to take partnership taxation? Chuck?
Well, why you want to take partnership taxation is it is the future. What Cass and I have been working in this area since we both started, which was back when dinosaurs ruled the earth. But what was really instrumental with the development and explosion of partnership taxation was the creation and implementation on a nationwide basis of the limited liability company, which you will see in just a moment has clearly become the choice of entity for a variety of reasons. The slide that you see right before you, though, illustrates the key point. This slide is basically, Cass, I believe this came off, this is data compiled by the IRS. This is not anything secret. Shows in diagram form the number of C corporation returns versus returns that are filed by pass-through entities. Now, there are two kinds, in my world, there are two kinds of pass-through entities that we worry about. We worry about partnerships, which is the subject of today's discussion, and we worry about S corporations. S corporations have a long and illustrious history of their own. They have a whole set of rules. One of the things we will warn you about now, one of the great misleading statements that you will hear is an S corporation is a corporation that's taxed like a partnership. That's not really true. S corporations have their own regime of taxation. What they share with partnerships is that both entities are what we call flow-through entities. They are entities in which the entity itself does not pay the tax, but the members of the entity, the owners of the entity, pay the tax. And the entity becomes a device for tax purposes of allocating that income amongst the owners. If you look at this diagram, you see an explosion in the number of pass-through entity returns. There were two developments that brought this on. The first was the so-called check-the-box regulations, which we're not going to bore you with today, which made it very easy and very clear what kind of entity you were for tax purposes. And this was in direct reaction to the creation of an entity called the Limited Liability Company, which the first statute goes back into the 80s. The first ruling was in 88. But in the early 90s, took off like a rocket and became the dominant form of business enterprise. Because the limited liability company, and if you look at the next slide, you will see that of the entities which are taxed as partnerships, there are three lines. We look at limited partnerships, we look at general partnerships, and we look at limited liability companies. And we see that the limited liability company line has exploded. And the reason the limited liability company line has exploded is it's a form of entity which is taxed like a partnership, but can do almost anything from a contractual point of view. Again, Cass and I were both on the drafting committee for the Georgia Limited Liability Company, and if you read that statute, you will see in the back one of the interpretive provisions says that limited liabilities are intended to embody to the fullest extent possible the concept of freedom of contract. So in a limited liability company, you can agree to almost anything as a matter of corporate governance, or I should say business enterprise governance. So they're very attractive on the the enterprise side, they're also very attractive because they are taxed as partnerships, which is crystal clear. And so why do people want to be partnerships? And then I'll be ready to turn it back to Cass. It's because the thing you learned in your first tax course. The difference between partnerships and corporations is that corporations are separate taxpayers. They pay their own tax, and therefore earnings from a corporation are potentially or almost always subject to a dual level of taxation, which is taxed first at the enterprise level and then taxed again when it's distributed to the owners, either as dividends or as liquidating distributions. That can result in combined effective tax rates that are very, very high, well in excess of 50%, 60% in some cases. If you have a flow-through entity, the owners only pay tax at the owner rates. So you avoid that corporate level of taxation. It didn't take long for everybody to figure out that it's almost always better to pay one level of tax rather than two. And in today's world, the only people who organize entities as C corporations for non-publicly traded enterprises have very compelling reasons to do so, because most people are going to organize their business as an LLC, and most of those people are going to be elect to be taxed or treated as a partnership for tax purposes. So the number of partnership tax returns is rocketing and is a growth area for lawyers and accountants. It's going to be something that those of you who work in the business world are going to continue to have to learn more and more about. Cass?
Thanks, Chuck. So, with that, let's start with the income tax definition of a partnership. And there'll be time later in the semester that we'll go into this in more detail, as well as the check the box rules. The point here is notice how incredibly broad this definition is. Partnership includes a syndicate, group, pool, joint venture, or other unincorporated organization. So if it's not a corporation, like it's an LLC, then the default rule is it'll be taxed as a partnership. The elements of the statute, or the essence of the statute, is just two or more persons, an intent to share profits. It doesn't require writing. There's no formal legal entity. A handshake arrangement can constitute a partnership. So now you may have learned in unincorporated business associations or in corporations all the rules that relate to the formation of an entity and that entity's ability to contract with other parties and governance, et cetera, et cetera. But for tax purposes, we want to think of a partnership in an LLC as really just a combination of two or more individuals that are doing business together. That's it. That's the simple concept from a tax and an accounting standpoint. So now, let's move on then to the next slide. Chuck?
Picking up from Cass's point, the goal with partnerships, from a tax point of view, is flexibility. And I don't want to steal the thunder in your slides that are coming. But you've got to remember the background from which partnership law evolved. It evolves from agency law, which used to be a course in law school. And the concept of partnership is that it's literally individuals or businesses coming together to figure out how to make money and divide profits, or if they lose money, how do they share the losses. It's completely meant to be free. The paradigm of the subchapter K, which are the tax rules that govern partnership taxation, is to facilitate these very informal business relationships and not to get in the way. The goal being that, generally speaking, if one had to say what's the default rule is you don't have a taxable event when you put stuff in a partnership, and you don't have a taxable event when you take stuff out of a partnership. That's the paradigm. The majority of subchapter K is then devoted to how do we make sure that people don't abuse that principle to achieve untoward tax results. But freedom of contract and flexibility is what makes the partnership so attractive. Again, these are flow-throughs. The paradigmatic example of a partnership type entity would be a law firm. And that's a law firm like, a 3-person law firm, or it could be King & Spalding or Morris, Manning & Martin with, 100 or 300 or 400 partners, which becomes a device for how do we allocate the profits and losses of the business to the partners. How do they conduct business together in an enterprise, and then we can allocate the profits from that activity to the owners, who will then pay tax on their efforts. So, a partnership for tax purposes, now, and Cass made this point already, for tax purposes, the best way to think of a partnership, if you have this orientation, is it's a big, fancy accounting device. It is just a very complicated set of entries to figure out how much money and how much profit each member of the enterprise makes. Now, notice I said for tax purposes. This has nothing to do with the business entity form. You know, you've got, if you're an LLC or a limited partnership or a limited liability partnership or a general partnership, you got all kinds of governance issues and legal issues. And yes, that is very much an entity insofar as the non-tax world is concerned. But remember where Cass started with the definition. Literally, I can shake hands with Cass right now, and we're gonna agree to write. We're gonna license this video, and we're gonna share the profits. And Cass is going to get 60%. I'm going to get 40%. We got a deal?
Oh, if we could only be so lucky.
If we could be so lucky. If we do that, we've just formed a partnership. Now, for tax purposes, the only thing the government cares about is that Cass reports his 60% and I report my 40% of the profit. For legal purposes, we'll worry about how we organize it. We might go one step further and form a limited liability company. You know, we could do a lot of things, but we don't have to do those things to have a taxable partnership. So, how do we keep track of profits and losses? The answer is, and this is a word that we're going to now spend almost the rest of the time talking about, is capital accounts. A capital account, and again, those of you, once you start practicing in a firm, especially if your firm is organized as an LLC, you're going to worry a lot about capital accounts. Because what is the capital account? The capital account, to use a very loose analogy, is your bank account. It is your share of the undistributed equity in the enterprise. And so, again, we're going to go through these rules. It starts with what you put in, you add to it what you earn, and you reduce it by what you take out. I mean, that is the grand design. It's a very simple concept. Just like at the bank, you put $1,000 in the bank. Back when banks used to pay interest, you would earn interest. The interest would be added to your $1,000. And then you would take interest out sometimes, or you might take it all out. So it's a very similar concept. So if you think of a capital account with this very simple conceptual background, it's not as frightening as a lot of people find it to be. But you must understand the basic principles of capital account accounting. Now, we are not trying to make you accountants. I will tell you, I'll give you a little sermon. I get one of my favorite sermons. You know, like Wallace Simpson said, you can never be too thin or too rich. Well, you can never be too thin or too rich or know too much about accounting if you're going to be a lawyer. Because as a business lawyer, everything you do is permeated by accounting concepts. Because you're always arguing over who made the money and who owes who what. In the partnership tax context, the same is true. You must understand the partnership capital accounting rules in order to even understand what is being said. Because the partnership capital account is where you true it all up and figure out what your share of the enterprise is at any time. And this is where Cass is now going to demonstrate his genius, because he has the extraordinary ability to take very complicated concepts and make them intelligible, which is why I do the big picture stuff and he does the hard stuff.
Goodness, you've set a high bar.
I've set a high bar.
A very high bar.
I know you're going to do it. I know you can do it.
And one other point of emphasis I want to make too is, and I tell this to my students in my partnership tax class on the first day, you must get out of the habit of thinking of percentage interests or how much stock does a person own, how much of the entity does any given person own, because the use of the term percentage interest in the partnership world really and truly tells you nothing. Okay, and we'll elaborate on that in just a moment. The essence is these capital account rules and what's in your capital account. And we'll start to break down for you the difference between a profits interest and a capital interest and so forth and so on. Again, at a very basic level to hopefully help you this semester. So let's start with, first, our partnership. So to illustrate our partnership, I have chosen a coin sorter. As Chuck mentioned, the best way to think of a partnership for tax and accounting purposes, it's just a device. It's a device to figure out who gets what and who pays tax on what. So I thought a coin sorter was a good way to illustrate that. So then let's talk about capital contributions. What are capital contributions? That's the money or property that you put into the partnership, that the partners put into the partnership to build the building, or to create the coin sorter, or to construct the manufacturing plant. Whatever it may be, those capital contributions are the money that those partners put in. Does every partner have to make a capital contribution? No. No, that is one of the things, again, illustrating the principle of partnerships. Very, very easy to form, okay, and they're also equally easy to dissolve. Now, balance sheet. What's a balance sheet? Simply put, a balance sheet is a snapshot of a business's financial condition at any given time. Okay? We're going to show you a balance sheet in just a moment. But it's really just that. What's the assets? What assets does it have? What liabilities does it have? And then what amount of equity, if any, do the owners have? And that's illustrated in this simple format that we'll show in just a minute. The fundamental formula is assets equals liabilities plus equity. So let's just take a simple example. We have partners A, B, C, D, and E. A puts in $20 worth of land, B puts in $10 worth of equipment, C, 5 in cash, D, 3 in cash, and E puts in nothing. Contributes nothing to our new partnership. What's the balance sheet going to look like? It would look like this. Okay? Notice on the left-hand side under the assets column, we have land, equipment, and cash listed at their values, their stated values. There's currently no debt in this partnership on the right-hand side. And then we have the partner's equity, which is the blue section of this slide. And we're referring to them now as capital accounts. You'll understand that a bit better in a moment. But just think of it now as the equity. Okay? Well, since we had no liabilities in this partnership, newly formed, the money that was put in by the partners equals $38. The total assets are $38. Assets equal liabilities plus equity. Okay? Simple enough, huh? Now, liabilities. Simply the amount of debt. The amount of debt of the partnership. Typically, as you may learn in secured transactions or other courses, debt is secured by an asset, like a mortgage on real estate, but it doesn't have to be. Okay? So let's just assume for the moment that our partnership, our ABCDE partnership, borrows $12 to purchase furniture. What happens to the balance sheet? Okay? Notice the highlighted sections of the slide. First, ABCDE partnership bought furniture, right? Paid $12 for it. We enter that in the asset side of the balance sheet, $12 for furniture. On the liability side, we enter $12 because now our partnership has a liability of $12. Did it affect the equity in the partnership? No. That did not change. Okay. Does our formula still work? Yes. Total assets are worth 50. Liabilities are 12 and equity is 38. Assets equal liabilities plus equity. Okay. Not so hard, huh? Pretty easy stuff. Fundamental. Fundamental. The fun stuff is going to come when we do tax, and we'll focus on that later in the semester. This is just the basics of the vocabulary, so we can talk to each other in class and understand each other, what we're talking about. Okay. So next, Chuck, would you like to talk a little bit about allocations?
Allocations are the entries you put into the books and records of the partnership to determine, separate out each partner's share of income and loss over the life of the partnership. Now, as a partnership generates revenue or expenses, and it will be able to allocate revenue and expenses, let me stop and make a point that is often overlooked, and as we're going to talk about more in a second. Do not confuse allocations with distributions. Those terms are often used loosely. They are very different. An allocation is simply an entry. It's a bookkeeping entry. I'm going to allocate to Cass $12 of revenue that we've earned. I'm going to allocate to Cass $6 of expense we've earned. I'm going to allocate to Cass the $28 he spent on lunch today as a charge to his account. That's an allocation. A distribution would be, I'm going to pay Cass some money, okay? A capital contribution would be Cass is going to put some money in. But an allocation is just a bookkeeping entry on that score. Allocations can be of what we call, I don't want to go too far on this, but you can allocate bottom line profit and loss, which is what most people think about, but you can also allocate gross income, which is often best thought of as revenue. People talk about I have gross income. That just means that's the money I took in the door. I could be taking a lot of money in the door and still go broke. That's gross revenue, that's gross income. Or I could be allocating net income, which is the profit I have after I've had the income, the gross income, and paid the associated expenses. So, and then there's another word that scares non-accountants that you need to get comfortable with. It's called debits and credits. What's a debit? A debit is a reduction. What's a credit? A credit is an add. So, if I pay a bill, if the partnership has a business and it pays a bill, that's going to be a debit to the partnership's cash account. If the partnership collects revenue, that's going to be a credit to the cash account. I'm not going to go any further than that because people get real confused when you start about debiting and crediting liabilities. But if you think credit is a plus, debit is a subtraction, just remember that concept, and you'll see we're going to use that a lot as we go forward. Okay?
Right. And just to follow up on what Chuck said, notice in our coin sorter depiction, the revenue comes in the top, and then the allocations work to then deposit the coins, revenue, in the capital accounts. Okay? The capital accounts for partner A, B, C, D, and E are there in the middle of the coin sorter. They're receiving as a credit on the books and records of the partnership. No partner has received and put in their pocket a dime. I should clarify that. They have been credited with revenue on the books and records of the partnership, and that has gone into their capital account. Another way to think of it is their internal bank account. It's the amount of money that I'm entitled to from this partnership, and it's recorded on the books and records. Now, distributions, as Chuck stated, are different. Distributions are where the money is taken out of the partnership and the partners then receive it and are free to do whatever they choose with it. So allocations are merely crediting or debiting the books and records of the partnership with the income generated. Distributions are taking money actually out of the partnership. Now, you'll see this again later this semester. It's where it gets fun. Taxes flow through regardless. Makes no difference whether you've been allocated and distributed something or just merely allocated something, you will be taxed on that income. So, and this is often referred to sometimes as, quote, phantom income. The idea that you have income you must report and pay tax on even though you did not actually receive a cash distribution from the entity. This is very, very, very common in partnerships.
And let me, on that one, to analogize it, going back to the concept of, if you're thinking of the capital account as like a bank account, it would be just like the results you would get if you put money in the bank and the bank credited your interest. They credit your account with interest earnings, but you don't take the money out. And if those of you who do your own tax returns may have gotten what's called a 1099 from the bank that says you earned $4.63 this year on your money market account. Well, the IRS, it requires you to report that $4.63 as income, even though it's still sitting at the bank. Same concept in partnership. Even though the partnership doesn't distribute the money, if the partnership makes money, you are required to report for taxable purposes your share of that profit, even if you don't get it. And that, by the way, is what drives most people nuts, because they don't understand how they can be taxed on money they haven't gotten yet. But it happens all the time. Back to you, Professor Brewer.
Thank you. So, let's take another simple example. So let's assume that our ABCDE partnership makes $20 during the year. And let's further assume that A has a 50% interest, B 25, C 15, D 5, and E 5. Now I want to pause here for just a moment and recall when we set up this example, E contributed nothing. E contributed no cash to this partnership, no property, nothing. But yet these partners have agreed, which they're free to do, that E will receive 5% of the income of the partnership. Okay, now why would you do that? Well, perhaps E has the know-how, has the knowledge, has the expertise. Perhaps E is the marketer in the group. Okay? Perhaps E brings the contacts. Okay? Whatever it may be, these partners have determined that E is worth 5% of the revenue of the partnership. Completely acceptable and fine. Again, do percentage interests here represent contributed capital? Absolutely not. Okay? Okay? We know what the percentage interests are, but it's told us nothing about capital. It's told us nothing about who put in what. Now, another important point of emphasis here, and I would like Chuck to talk about this a little bit, is that the difference between capital and profits interest. This bears re-emphasizing. Oops.
Well, yeah.
Forgive me.
Well, again, we're going to, in the course of this semester, we're going to spend a lot of time on this because this is one of the most complex concepts that you have in partnership taxation, which you do not have in corporate taxation. I mean, there is no comparable concept in the world of corporate entities. The concept is, and Cass was referring to, you have two partners who come in, both of whom get 5% of the profits. One puts in capital, the other does not. The fellow who has put in the capital is a capital partner because that partner has a share of profits and capital. The partner who comes in and who has not put in capital is referred as holding a profits interest. What is a profits interest? It is exactly what its name says. It's an interest in profits. If there is no profit, you have no interest. You only get money if there are profits. A capital interest, on the other hand, is an interest in the liquidation value of the enterprise, basically at the time you do it. So again, in our example that Cass has set up, if a partner has put in $5 and the day after you formed the partnership and you decided that you hate each other and the deal's not going forward, you hand everybody their money back. Partner E, who did not put any money in, does not get any money out. That's a profits interest. Partner D, on the other hand, who did put money in, does get money out because he or she is getting a return of his capital. So every partnership interest, this is where it gets really interesting, has that you're going to see in your life is probably going to have both a profits interest and a capital interest, which again, there is no analog for this in the corporate world from a tax point of view.
Okay.
Back to you, Cass.
Thanks, Chuck. So let's remind ourselves of our facts. Our partnership, ABCD partnership, has made $20, and then we have the ratios between A, B, C, D, and E on their sharing ratios. We've already stated. What happens to the balance sheet? And what happens now to their capital accounts? Okay? Because we've now introduced the concept of capital accounts, your internal bank account in the partnership, where amounts are credited to you. What happens to those? All right, so first, on the asset side of the balance sheet, we originally had, ABCDE originally had $8 in cash. It's now earned $20. So that $20 of cash is credited to the asset side of the balance sheet. That brings our total assets up to $70. Liabilities haven't changed, right? Nothing's changed there. $20 made by the partnership is then allocated, not distributed, allocated among partners A through E. Well, if it's $20 and partner A has 50%, partner A is entitled to $10. Originally, $20 was in A's capital account. That was A's equity. Plus 10 is 30. B receives $5. B's capital account originally was 10. Plus 5 is 15. C went from $5 plus 3 to 8. D went to 4, and E, who put in nothing, now has actually $1 in E's capital account. That represents 5% of the profit of $20. Now look at our ratios again. Remember our formula. Assets equal liabilities plus equity. Equity is in the blue portion of the balance sheet. Do the assets equal the liabilities plus the equity? Yes. 58 plus 12 is $70. Our balance sheet balances.
Ergo the name.
Exactly.
Ergo, the clever name they came up with.
It is, indeed. The accountants are always so clever.
Oh, so clever and so witty.
So now we have shown the allocations. Okay. Let's move on now. And let's assume that our partnership, our ABCDE partnership, decides to distribute, to actually pay to its partners some money. Okay? Well, in this case, we're assuming that ABCDE pays $10. The partners have agreed that they're going to share in distributions the same way they shared in allocations. So A is going to receive 50% or $5. B is going to receive 25% or $2.50, and so forth and so on, as you can see on the slide. What is the impact on ABCDE's balance sheet and on the partners' capital accounts? Okay. Again, our formula, assets equal liabilities plus equity. Well, on the asset side, the partnership no longer has $10 that it had before, right? It's distributed that to its partners. So we debit on the asset side $10. It was $28, less 10, 18. Has anything happened with liabilities? Nothing. What about the equity? Well, partner A received $5, B $2.50, C $1.50, and then 50 cents each for D and E. We reduce their capital accounts. A went from 30 to 25. B, as I recall, went from 15 to 12.50. So forth and so on. Their equity, their internal bank account in the partnership has now been reduced. Do assets plus liabilities plus equity equal? Yes. $60 in assets, $12 in liabilities, $48 now left in equity in their capital accounts. All is right with the world. Now, let's next assume that ABCDE pays $5 of the principal on the debt. So it takes $5 and pays the principal on the debt. What happens to the balance sheet? Well, does the partnership have less cash? Absolutely. It's paid to the creditor, $5. So now the asset side is reduced from 18 to 13 by $5. On the liability side, what's happened? Liabilities have gone down, right? So the liabilities have gone from 12 to 7, the amount paid. Total liabilities now equals 7. Did anything happen to the equity? Nothing happened to the equity, right? Okay. You simply took an asset that you had on the asset side and you used that asset to pay a liability. It had no effect whatsoever on the partner's capital accounts. Now, later in the semester, you will learn that this will have an effect on the partner's outside basis in the partnership. But that's not the subject for today. Today is simply dealing with the effect on the balance sheet and capital accounts. Okay. But if you're reviewing this video later, understand that liabilities affect outside basis. They do not affect payment of the liability if it can affect outside basis, not capital accounts.
And Cass, on that score, just this is just the reverse of when we had the original borrowing. Just like the borrowing does not increase or decrease equity because cash went up, but the liability went up. Here, cash is going down and the liability is going down, but the equity is unaffected here. And that's, again, that's the magic of the balance sheet. They go up and they go down, but the total would still remain the same. The total equity would remain the same.
Excellent. Great point. Great point. So once again, our balance sheet, assets plus liability, assets equal liabilities plus equity, $55 on the asset side, 7 on the liabilities plus 48 equals 55. Okay? And by the way, this is the other thing I tell all my tax students. We only do 8th grade math. Okay?
That's why we're lawyers.
That's all you need to know to be an exceptional tax lawyer is 8th grade math. Okay? So, to sum it up, balance sheet. Balance sheet is your assets equals liabilities plus equity. In the partnership context, the equity is going to be represented by capital accounts. Okay? Income or loss of a partnership is allocated. Cash or property is distributed. Different concepts. And the capital accounts, as we will learn in much more detail later in the semester, are going to be equal to the capital contributions plus or minus the allocations minus distributions. Hopefully, this has given you some insight into partnership tax accounting, so we can now have a lot of fun talking about the legal and tax aspects. Chuck, any closing remarks?
No, I think Cass, you've done a great job. It's going to, before we give you a false sense of comfort, this is going to get very complicated very fast. But if you remember this fundamental starting point, you've just got to always go back to the fundamentals. It will help you as we move into the discussion because the accounting for this will get very sophisticated, very complex, but at least now you have the basic vocabulary so we can talk about this using the same language. So I want to thank Cass for putting this together because I think it's a really, really valuable resource and look forward to working with you this semester as we charge off from here.
Thank you, Chuck. Thanks for being here. Good luck to you. And for those of my students here at Georgia State, I will see you in just a week or so.
Thank you.
Signing off.